Welcome to TalkTickers, your shortcut to being well-informed on the market's most important updates. Today, we're doing a deep dive into the latest earnings call from a major exchange operator. Quite a quarter they had.
Oh, absolutely. A very strong showing, really demonstrating resilience and, forward momentum in what's still a pretty dynamic market.
So we're going to unpack the headline numbers, get into management's insights, their strategy, and look at what it means for the market and for you.
Okay, let's unpack this. Let's jump right into those headline numbers.
Right.
Record-setting quarter, right? We saw adjusted diluted EPS, that's the earnings per share figure everyone watches, come in at $2.46.
Yeah, and that was a solid beat against the $2.44 consensus estimate from analysts, so better than expected there.
And the top line, revenue.
Just as impressive. Net revenue hit a record $587.3 million. That outperformed the consensus of around $576 million by nearly 2%.
Wow.
And importantly, that's a robust 14% increase compared to last year, year over year.
That's strong growth. And that momentum, it carried through to the operating margins too, didn't it? It certainly did. Adjusted operating margin expanded 230 basis points year over year, reaching 63.7%.
Okay, 63.7%. So seeing margin expansion with that kind of revenue growth,
right?
Well, that's powerful. It really signals they're growing efficiently.
Yeah.
Translating more revenue to profit.
Exactly. Operational leverage in full effect. So overall, a strong financial picture that clearly resonated, setting the stage for, digging deeper.
Right. So these numbers look great, but how did they pull it off? What did management say? The CEO highlighted, and I'm quoting here, record quarterly net revenue and durability across our exchange ecosystem, pointing to robust volumes in derivatives, strong new sales in their Data Vantage business, and disciplined expense management.
Yeah, those are the key pillars.
And all that contributed to record first half results for the firm.
And if we dig a bit deeper into those segments, options revenue surged, up 19% to almost $365 million.
19%, okay. Driven by volatility, hedging.
Precisely. Heightened market volatility and, increased use of options for risk management, people looking to hedge. And outside the U.S., Europe, and Asia-Pacific revenues, they jumped 30%.
30%. Wow.
They're over $70 million. That's pretty compelling evidence that their acquisitions and geographic expansions are really adding value, compounding growth, not just shifting it around.
So it's not cannibalizing, it's adding.
Exactly. And Global FX also saw a healthy 19% revenue increase, so the multi-asset strategy is clearly working.
Okay, so growth is strong. But you mentioned efficiency too. Management seems really focused there.
Yeah.
They actually raised their 2025 organic net revenue growth target.
They did, up to high single digits now, from mid to high before, shows increased confidence.
But here's what I found really interesting. They did that while cutting their adjusted operating expense guide. How does that work?
Well, that's the key insight, isn't it? It sends a powerful message. They trimmed the expense guide by $5 million at the midpoint, down to a range of $832 to $847 million. It shows they're confident they can grow revenue faster while still improving margins. It's about discipline, efficiency.
So strategic investment and margin expansion. Not always easy to pull off.
Not at all. It demonstrates a really sophisticated approach.
And speaking of discipline, the wind down of their Japanese equities business.
Yeah.
Walk us through that. Why is shutting something down seen as a positive here?
Right. Well, it might sound counterintuitive, but it's expected to deliver $10-12 million in annualized savings starting next year.
Okay, significant savings.
And management was clear. It reflects a philosophy of putting resources where they get the highest potential return. They're redeploying that capital towards derivatives and FX initiatives where they see better growth prospects.
So pruning the portfolio to focus on the core strengths. Makes sense.
It's pragmatic. Plus, they continued share buybacks, $35 million in Q2 alone, and the regular dividend, all signaling shareholder value.
Okay, let's talk growth drivers.
Right.
Tailwinds.
Yep.
Options volumes are obviously benefiting from macro volatility, right?
Yeah, clearly. The VIX, the fear index, it spiked above 20 during the call window itself.
Yeah, I saw that.
That signals elevated uncertainty, driving hedging demand. It shows there's a sustained need for their products right now.
And this is where it gets really interesting, I think. The Zero DTE options. 0 days to expiry.
Still a huge structural tailwind.
Volumes just keep growing. Made up a record 57% of total SPX options volume in Q2.
57%. And management stressed this isn't just, a fleeting trend. It's wider adoption, new use cases, people using it for very precise short-term risk management or bets.
And it seems sustainable, even with more retail participation.
Right, and resilient through volatility spikes, too.
So if zero DTE index options are booming, what about zero DTE single stock options? Is there a risk they compete?
Management sees them as complementary, not cannibalistic.
Complementary? How so?
The thinking is, as retail traders get more sophisticated with single stock products, they'll naturally gravitate towards index options later. Because index options have unique benefits like cash settlement, European exercise, potentially simpler for certain strategies or tax situations.
Ah, I see. So it's like a potential pathway for traders.
Exactly, a progression.
And the other big driver they mentioned was Data Vantage, their analytics suite.
Yes, accelerating migration to the cloud, expanding globally.
And the international demand there is striking. You said 45% of new data sales outside the U.S.?
Roughly 45%, yeah. And 85% of their Cboe Global Cloud sales are international.
Wow.
It really suggests data sales are a leading indicator for future derivative volumes. It's all interconnected.
Like mapping out future trading hotspots.
Kind of, yeah. And the new CEO reinforced that commitment to continuous improvement, adapting, delivering more value.
So exploring opportunities, organic and inorganic.
Yeah.
But optimizing the core, too.
Very much so. Rigorous financial discipline alongside growth initiatives.
What about M&A? The CEO has a background there, right?
He does, but he was clear. Any deal would need a really compelling strategic and financial rationale.
So no immediate pressure to buy something just for the sake of it?
Exactly. They feel they're in a strong position. Opportunistic, but measured. Confident.
Okay. And one last key thing from the Q&A. The OCC margin model changes.
Ah, yes, that was important. They now expect a much less material impact on capital requirements than they first thought.
Less material. How much less?
The estimate is down to about a 1% capital impact from maybe 5% previously.
Yeah, that's a big difference.
Huge. It eases concerns about it potentially slowing down zero DTE growth. Basically removes a potential hurdle, a significant de-risking.
Got it. So let's talk market reaction. How did investors take all this?
Decidedly positive.
The share price climbed nearly 3% on the day.
Yeah, from around $241 to almost $248. And that was on a day the S&P 500 declined 1%.
Right, so significant outperformance.
Absolutely. Pre-market was strong too, over $247. And volume was way up, like 1.5 times the average.
So even with the broader market looking shaky, investors like this story.
It speaks volumes, doesn't it? Confidence in that durable volume growth and the cost discipline narrative. Sell-side analysts were calling it another remarkable quarter, highlighting the options franchise strength.
In the broader context,
Yeah.
other exchanges are also benefiting from hedging demand, right? Sector-wide tailwinds.
True, but this operator seems particularly well-positioned with its diversified offerings and that strategic focus we've been talking about.
So the story is multi-asset expansion, disciplined execution.
Exactly. Acquisitions compounding growth, new management showing cost control while investing in innovation like Zero DTE and data. And they have a strong balance sheet, over $1.2 billion in adjusted cash. Lots of flexibility.
The narrative really does seem to be tilting towards sustained double-digit EPS growth.
It does.
Looking ahead then, what are the catalysts to watch?
Well, the monthly volume updates are key, especially that Zero DTE mix.
Wait.
Then there's the completion of the Japan wind down, expected late August. A possible uptick in volatility this fall, maybe tied to Fed rate cut talk, could boost options demand further. And the Investor Day in November. The CEO is expected to unveil a refreshed capital return framework then.
Okay, lots to keep an eye on. Seems like a compelling story if that macro turbulence continues.
Definitely a thesis that could find continued support.
Okay, now for our segment. This is not financial advice. Where we pitch an outrageous but plausible trade idea based on today's deep dive. Think of it as a simulated pitch. Your turn first.
All right, well, given those clear tailwinds and options, the management's focus on capital discipline, that trimmed expense guide, and the strategic resource shifts, here's a thought. Consider a long position in this exchange operator,
Right.
maybe targeting a move beyond its recent highs. The bet is that sustained macro volatility keeps driving those derivatives volumes, especially Zero DTE.
Right.
And the new CEO's perspective, optimizing the portfolio, his measured M&A stance, it signals potential for more value creation down the line.
Okay, along the exchange operator. How do we make that truly outrageous but plausible? Pair it with something.
How about this? Pair that long position with a short on a less diversified exchange.
Ooh, interesting.
Maybe one more regionally focused, heavy on cash equities, perhaps. One that hasn't shown the same agility in shedding non-core assets or capitalizing on global data and derivatives.
Right. So the underlying thesis is What?
Yeah.
The diversified innovator wins out.
Something like, in an uncertain macro world, the diversified, disciplined, innovative leader captures share and profit, leaving slower players behind.
It's a play on strategic adaptation versus inertia.
Exactly. A high conviction play on management execution and those macro trends. But, markets can always surprise you.
Yeah.
Really speculative for discussion.
Absolutely. Not financial advice. So to recap, a really strong quarter.
Yeah.
Driven by derivatives, global expansion, cost management, all underpinned by a clear strategy under new leadership. Record first half results.
Yeah. Impressive execution, leveraging secular trends, allocating capital wisely, really showing how to drive value in a tough industry.
Strategic clarity meets operational excellence.
Well put.
Okay, just a reminder. The information shared here is for informational purposes only. It is definitely not financial advice. Investing involves risks. Always do your own research. Consult with a professional.
Absolutely. We hope this deep dive gave you some valuable insights into this call, though. What really stands out to you about their approach? Something to think about.
Join us next time on TalkTickers for another deep dive into the numbers shaping the market.